Hello everyone, I am Gabriel. With more than 15 years experience as a licensed financial professional, protecting families' income and investing their money for a better financial future, I am here today to show you what is the first step in building a strong financial foundation. I am precisely talking about income protection. Basically, if someone depends on you, your husband or wife, your children, any family member or anyone else, you must have your income protected. Now, you might have never heard of income protection before, right? Although as an income protection, the financial industry calls it life insurance instead. When it comes to income protection, you have two basic choices: some form of cash value income protection or life insurance, including indexed universal life, and term life insurance. In cash value insurance, as a bundled policy, you buy both your death benefit and a cash value feature. However, this doesn't enable you to maximize the cash value benefits. And depending upon the type of cash value you are given, you might even lose, as you get older, the entire cash benefit. These concerns have led many leading financial experts to direct consumers away from cash value life insurance. Let us take a look how these cash value life insurance work. The following are, in general terms, graphical examples of how these policies behave. Let us look at the first example: whole life insurance. As the name implies, this type of life insurance is there for you until you reach 120 years, or your entire life. You are buying an insurance coverage of $500,000. You are paying a fixed premium of $200 per month for your coverage and your investment. It has a guaranteed investment growth. Unless a paid-up addition rider is added to this type of insurance policies, that makes them less affordable to clients, as the premium is much higher. When you die before reaching 120 years of age, your beneficiary or beneficiaries will only get paid the face amount of the policy. In this particular example, $500,000 distributed as you have originally set when the policy was issued, and the insurance company will keep what you have accumulated in cash up until you die. Isn't that something? You have been paying for two things, and your beneficiaries get only one. Another type of cash value insurance is traditional universal life. These policies are a variation of whole life insurance. In this particular example, you are also buying $500,000 of coverage. You are also paying a fixed premium of $200 per month for your coverage and the investment portion of it. Your cash value grows initially, but look what happens to it, represented by the green dotted line in the graph. It starts to deplete. As you get older and the cost of insurance gets higher, shown by the red line on this graphical example, your premium monthly payment is not enough to cover it, and automatically that shortage is taken from your accumulated cash value. There is a point in time that your cash value completely depletes. And if you don't deposit a substantial amount to cover for this deficiency, your policy lapses. Imagine that you were thinking you were covered and at the same time saving money, and after 20 years of doing so, you find out that you have lost all your investment. This is the case when option 1 or option A has been selected when the policy was applied for. Typically, because it is more affordable for clients and in order not to lose their business, that is the option applied by unscrupulous agents by default. Isn't that terrible? On the other hand, if option 2 or option B was applied for, the monthly premium for a $500,000 face amount policy would be more than double the amount of option 1 or option A, and the cash value growth would be much less than investing the difference in a Roth IRA with an underlying mutual fund. In mid-1990s, a new variation of a traditional universal life, a hybrid between traditional universal life and variable universal life, was introduced. They have called it indexed universal life. These policies combine the components of a traditional universal life with a new method of crediting interest usually tied to the performance of a stock market index, such as the S&P 500, with a cap, for example, 10%, and a floor, 0%. As the traditional universal life, the same thing happens, and the cash value, the green dotted line in the graph, starts to deplete as the cost of insurance exceeds the premium you pay. When your policy completely runs out of cash value, if you don't deposit a substantial amount to bring back your cash value to a certain level, your policy will lapse, and you will not even have coverage anymore. Similarly to a universal life policy, this is the case when option 1 or option A has been selected by default when the policy was applied for. Horrible, isn't it? Likewise, a universal life insurance policy, if option 2 or option B was applied for, the monthly premium for a $500,000 face amount policy would be more than double the amount of option 1 or option A, and the cash value growth would be much less than investing the difference in a Roth IRA with an underlying mutual fund. Even though through the years they continue to enhance indexed universal life policies, from an investment perspective, there is still nothing like acquiring low-cost term life insurance and investing part of what you would have paid in an indexed universal life policy in a tax-free investment vehicle with an underlying mutual fund account. Now, why these cash value policies work like that? They work using a method of what is called annual renewable term life insurance. It is seamless to you, but your policy renews every year, and your cost of insurance goes up inside the policy. That is why there is a point in time that the cost of insurance becomes larger to what, in fact, you are paying monthly, and the difference is taken from your cash value until it completely depletes. With cash value life insurance, how do you know what are you paying for? This can be hard to determine in a bundled product, especially with indexed universal life, IUL. In addition to the cost of death protection, cash value policies may have significant fees. And with the two-in-one approach, it's difficult to separate the cost of insurance from the other elements of the policy. Remember, anytime you are not sure what you're paying for, you risk making a bad decision. From the 1990s and beyond, term life insurance gained significant traction as a more affordable alternative to cash value life insurance. There are three types of term life insurance: level term, decreasing term, and annual renewable term. The most commonly used is the level term life insurance. In this type of life insurance, you'll be usually covered to age 95 with a fixed premium, much lower than those with a cash value component, usually for a period of 35 years. From age 36 to age 95, the premium will go up every year. As outlined in the graph, your coverage is $500,000 and your monthly premium is $100, which is half of the amount of those insurance policies having a cash value. If you buy term life insurance for $100 per month and invest the difference, $100 per month, you have greater control over your benefits. Because protection and savings are completely separated, you have a much better control over the death benefit and the investment portion. Buying term insurance typically allows you to get more insurance coverage for less money. Then you can use that money you saved to invest for the future and toward achieving other financial goals. In this case, you saved $100 by issuing a term policy versus a cash value policy. Investing these $100 difference in a Roth IRA with an underlying mutual fund will accumulate cash tax-free in an investment vehicle that will provide, at the end of the 35 years, an amount close to what your insurance coverage is. And therefore, you don't need to renew your term life insurance policy at the end of the 35 years term, when it switches to become an annual renewable term life policy. At that point, you'll already be self-insured. You'll have close to $500,000 or even more in your investment account. These accounts are ultimately managed by money managers with very extensive experience managing mutual funds accounts and backed by the most reputable investment companies in the United States. Now, you know what is the most convenient and a much better investment decision to make when protecting your income and saving for a better future. Regardless if you already have life insurance or not, I will be happy to provide assistance and to discuss one-on-one your options. If you have an insurance policy in place, I'll just review it to determine whether it is worth to keep it or if it needs to be replaced. I will provide a financial needs analysis free of charge. Just keep in mind that as a licensed financial professional, I will always put your interests first. That is what I do 100% of the time. To contact me, please scan the QR on the screen and schedule a day and time more convenient for you for us to meet. If it is easier, take a snapshot of the QR code, save it in your photo gallery, go to your photo gallery, tap the QR picture to open the form and schedule a meeting. I will see you soon.